All right. Let's stay with the economy. We're going to get to Iran in a little while, but let's stay with the economy. We've got two of the best, Douglas Holtz-Eakin, American Action Forum, former CBO director, Marc Sumerlin, Evenflow macro managing partner, former deputy at the National Economic Council. Marc, start with you. I'm redefining Goldilocks. It's not too hot. I mean, it's a lot of fun. You guys are laughing, and we should laugh. You got to make this stuff moderately interesting. But you know what? It just seems like right now, take a snapshot. Prices are falling. I know it's mostly gasoline, but it's not. You know, a lot of core numbers are very good. Anyway, prices are very mild, and the economy is very, very strong. We're seeing it again. Retail sales are big numbers. I bet you manufacturing is a big number too. Now, Marc, will it last? Can it last?
I think it can last. I mean, I think it was a good week for data all around, so we gotta celebrate those when you get them. Retail sales were very strong. I like to look at categories that are completely discretionary, like sporting goods, and those were up. And that tells me that people have enough money to be doing other things that they don't have to be doing. And we saw that confirmed in strong bank earnings, and I just want to give a little shout out to those, because every single CEO said the consumer was strong, and we saw bank balance sheets really expand. And what they pointed to was deregulation, and that some of the regulatory changes, the banks had really been in a box, and just letting that go a little bit has helped bank lending. And I think to your point is, I mean, we can always come back to this, it's if you get the supply side growing, then you do get the Goldilocks. If it's all on the demand side, then you're not going to get the Goldilocks. And so it's important on where you get it. And if I can just give one other little detail that was sort of interesting to me is we see on the auto sector is a good place where that's happening, where we see strong auto sales, but one of the two places where we see falling prices over the last year is prescription drug prices, and we see it in auto prices.
Right.
And so we can look to subsectors for clues on how to do the policy right overall, I think.
By the by, your point about banks, financial stocks have done very well. That's a leading indicator for the economy. It's a very important point. Doug Holtz-Eakin, come to you on all this and get your take. You know, we'll see about manufacturing tomorrow, but these early reports, the Philadelphia Fed, big numbers on Conrad DeQuatros was telling me on an ISM basis, the Philly Fed number was 69, which is off the charts. The New York Fed number was 57. I didn't even know New York had any manufacturing. So, I mean, if it were up to the governor and the mayor, it wouldn't have anything at all. But so, you know, people are not giving the economy enough credit. That's why this is the third straight night I've led with the economy and my riffs on the economy, because I just think it's an important point, and there's too much pessimism around.
So the stakes here were actually fairly high, because if you looked at the first quarter GDP report, you'd see a super strong business sector, no reason to be concerned, and you see, you know, personal consumption expenditure floating along at 0.5%, which is way too low. This just puts all those worries away. They're gone. The consumer's there. The household sector is strong. That's what we needed to get them both going in the same direction. The inflation has clouded the picture. You know, we've had this conversation on your show. Oil prices go up. They also come down. You look past that to the settings of policy, and you're going to get inflation under control. But people sort of lost track of that, I think, in the midst of the uncertainty over the war. The reality is that inflation is not the concern. It's the trend. And, you know, this Fed has said the right thing so far about getting back to 2. I think people are starting to believe it.
Yeah, you know, that's an important point. The dollar is strong. Gold, precious metals prices have been coming down, Marc Sumerlin. That's a very interesting market indicator. In the CPI break-evens, the tips market, those rates have come down. Like the 2-year note is under 2%. I think the 10-year note is just above 2%. So I don't see the Fed raising rates. I don't think the Fed's going to do anything until their task forces report, Marc. That was a point I made last evening. They're going to wait. I mean, they may as well not do it until they, you know, go through all the stuff about inflation and the balance sheet and communications and productivity and so forth and so on. You know, why move? If you're looking for a new regime, but your background is price stability, better to wait, isn't it, and then figure out what the experts are saying from these Fed task forces?
Yeah, I mean, I think the question here is what happens to the long end of the curve. I mean, and so what we really care about is the mortgage rate, and we need to bring that down. And it gets a little complicated because sometimes when you bring down the front rate, the long rate comes down with it, and sometimes it goes the other way. And so this is really like why Kevin gets the big bucks, because he's got to kind of make the market call on what's best for getting that long rate down so that we can get the housing market going again.
So what do you think? What should he do? Give me, for instance. I'm sure he's listening, by the way. He loves this show.
Yeah, no, I mean, I think he probably needs to hike one time this year to calm down long rates, just to settle the bond market down so we can get them back down and get that mortgage rate. 6.5% is just too high. It needs to come down, and I think that would give him a lot of credibility, and then he would not have to do anything for quite a long time. And he might be cutting next year, Larry, when we get into some of the better productivity taking hold, and once we're lapping the war, those annual CPI measures are going to be falling. And so I think if he, one hike here to cool things down, take it easy, and you might find yourself in a position where you're going to be cutting next year.
Well, Doug Holtz-Eakin, Marc Sumerlin is a very, very good economist, first rate, top of the line, and we are so happy to have him on the show as a regular.
Yes.
But I hope he's wrong on this. I don't want them to. I don't want them to raise the rate.
I never disagree with Mark, but he's wrong. I think
easy. He'll never come back. People get very sensitive.
No, I think they won't hike. They're watching the data. There's a lot of uncertainty. I don't think there's going to be a clear case to hike, and so they won't. They'll be waiting, and we'll see the mild restrictions of policy reveal itself, and they'll be comfortable with where they are. They could get some help. Like, the real help they need is from the Congress to sort of take care of the enormous fiscal problems that are also keeping the long rates up.
Why don't they cut spending?
That's the easy one. That's the easy one. Go cut the spending, fix Social Security, do something.
I know. You know what? So far, this reconciliation bill, so-called skinny bill, I don't see any spending cuts, Doug Holtz-Eakin. Now, this is your cup of tea, former CBO director. Why don't they do something? The deficit is, look, spending is the problem, and we're still spending too much money, and that's one reason why the deficit's so high.
Reconciliation 3 is a fast-track approach to spending more money. That is not my favorite set of words, okay? I don't like that at all.
You're right, Mark. It's a good point. Last point, Marc Sumerlin. This is a little bit in the weeds, but the GDP may not show the strength of the economy. I mean, I'm looking at the Atlanta Fed. So they raised their number from 1.3 to 1.7, I think, today. It was over 4 at one point. Now, maybe, but the trade deficit getting in the way. You subtract out from the trade deficit. It's very esoteric, and I don't know that our viewers, but it may keep the actual arithmetic of GDP lower. And the C+I, consumption and investment, may be booming, but you may not see it in the GDP report.
Yeah, I mean, so we had a one blip up in the monthly trade number, and don't forget when you do a GDP report, you're annualizing, so one number ends up being like 4 numbers, and so that took a full percentage point off of the Atlanta Fed's GDP now number, and so like I would look at that and add a point to it to think where reality is. Yeah.
Terrific.
And Larry, one more thing. I mean, we saw this last year where there's some front-loading of imports to anticipate tariffs. And so we're seeing businesses do that. That makes the number look smaller than otherwise.
Actually, that's really interesting. It may be that the deficit trade numbers, when they get the rest of the quarter, are a lot better. They may improve. That would help GDP. That's a great point. You guys are wonderful. Marc Sumerlin, please don't walk away. We love it. It's all in jest. Doug Holtz-Eakin's been telling me I'm wrong for years. I'm completely used to it. So it's almost an honor to have it. But you're both terrific. Thank you very much.